How do central banks use interest rates? In today's economy, many are asking how central banks use interest rates to influence financial stability. With recent discussions around inflation and economic recovery, understanding this topic is more relevant than ever. Central banks play a vital role in managing a country's economy through monetary policy tools. One of the most powerful tools they use is setting interest rates. Let's break down how this works. Interest rates are essentially the cost of borrowing money. When you borrow money from a bank, you pay back the amount you borrowed plus some extra money, known as interest. Central banks control these rates to influence the overall economy. Central banks set interest rates by adjusting the rate at which banks borrow money from each other. For example, in the United States, the Federal Reserve sets the federal funds rate, which is the interest rate banks charge each other for overnight loans. In Europe, the European Central Bank uses similar mechanisms like the main refinancing operations rate. By raising interest rates, central banks make borrowing more expensive. This reduces spending and helps control inflation, as people and businesses are less likely to borrow money when it costs more. On the other hand, lowering interest rates makes borrowing cheaper, encouraging people and businesses to borrow and spend more. This can boost economic growth by increasing consumption and investment. Interest rates also affect currency exchange rates. Higher interest rates in a country can attract foreign investors, strengthening the currency. Recently, during the COVID-19 pandemic, central banks like the Federal Reserve in the United States lowered interest rates to near zero to support economic recovery by making borrowing cheaper. In contrast, when economies are growing too quickly, central banks might raise interest rates to slow down growth and prevent inflation. This balancing act is essential for maintaining a stable economy. Central banks use interest rates as a key tool to manage inflation, support economic growth, and influence currency values. By adjusting these rates, they can either stimulate or slow down economic activity. Understanding how these mechanisms work can help you navigate your financial decisions in today's economic climate.